Well, hello, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host, and it is Wednesday evening, about 15 till 11, and I decided to go ahead and make a video because we've hit a crucial retracement area and started to fall, and so I thought it was important to go ahead and point that out and maybe issue somewhat of a warning. So this area right here is the 62% retracement area. So all that is if you measure from high to low down here, the retracement area is just how far the market's retraced since this first move down. So if you recall, so there's the 62% area, the 2750. But if you recall, we talked a lot about this in the bond market. So let's go over to the bond market real quick. The 10-year Treasury yield. If I can get that to... I'm not sure what the problem is. Let me make a little bit more space. And sorry about that. Just glitching a little bit. But we talked about... Okay, we talked about this low down here being an important low, and this first move off the bottom, being a first move off an important low, and the potential for this move off the bottom to be a wave one in Elliott wave terms. So if this is a wave one, maybe to here, then all this is the wave two correction, and potentially this is wave three. Now you can see how steep this is. I mean, it really didn't even come back and retest this downtrend line before taking off, and you start to see it accelerating. You see gaps here. There's gaps here, and there'll be some more gaps along the way, but that's characteristic of a third wave. This is probably the third wave of the first wave up. So you hit probably 1, 2, 3, and this is probably the third of a third. This is the end of 3, 4, 5. So this 5-wave move here is the first wave of a larger 1, 2, 3, 4, 5 that's going to continue for several years. So that could be what we've got going on over here in the S&P 500 or the Dow. The difference is that this could be. I mean, there's no way to really know, but this could be quite dramatic. And what I mean by that is it could be a rapid sell-off. It could be what we might call a crash. So I wanted to go ahead and put out a warning here. You can see this only took 2 weeks to come down here. We could come, whoops, that's the wrong thing. Let me start over. Let's get like this. We could come down way down below this 2,000 in 4 or 5 weeks, 6 weeks maybe. So that doesn't give you a lot of time to react, and a lot of times people, like I said before, the psychology starts to work on you, and it gets to here, and you say, well, it's probably closer to stopping than not, and so you wait another week, and then it goes to here, and you keep talking yourself out of selling, and it just keeps going lower and lower and lower. And so when we look at where's the potential area of support, it's this for the very, very short term, meaning in the next few months, if this market tops here. Sorry, I want to move this over. If the market tops here, the short term area for stopping is going to be down here somewhere below 1,800. So basically, you'd lose 2 years worth of gains. So most people don't want to do that. They don't want to lose 2 years worth of gains, and so you need to have some sort of, well, I say you need to have some sort of sales strategy that gets you out of this market. Now, one way you could do it, likely, so let's talk about the couple different scenarios. Let's say this goes lower, and then next week we close below. So we close below this low. Okay. It's possible that, so there's a couple scenarios. One, this is wave 2, and so the next thing will be wave 3, and it's going to just keep going. The problem is we won't know until it gets down below here somewhere. So the problem, obviously the problem with that is, you've lost, 15% of your money. The other scenarios is it could come down to this area, kind of where I've got drawn here, and it could bounce and head back this way, even to new highs. But first of all, that's unlikely at this point. I think the volatility that we've experienced, and we'll look at volatility in a second, tells us that something has changed here. At least it tells me that. Let's look at volatility real quick. Even though we had a similar spike here in 2015, we've had such low volatility. This was not as low, right? I mean, it was a different kind of environment. But the other thing is the COT data and the bullish percent data. This happened. This area right here was at 41%. 41-year extremes on bullishness, and the commitment of traders data was at they were at very divergent points between commercials and speculators, and that tells me that this is likely to be an important turn in the market. But like I said, there's really no way to know for sure until it goes back below this low on the S&P 500 or Dow, this low right here. The problem with waiting, until you get down there is like I said, you've lost 15% of your money. So you have to have some sort of sales strategy. You can always get back in if you get out soon enough, and maybe, you may just have to pick a point and just say, if it goes below that, I'm out. Okay, I'm just out. But like I said, if you thought this 2 weeks was violent, this next, 6 or 8 weeks, let's call it 4 to 6 weeks, is going to be extremely violent. I mean, it's going to drive people mad on CNBC and places like that. So just need to have some sort of sales strategy. That's what I need to say. And everybody has their own money and has their own goals, and so you just need to be smart about that and pick a place. Obviously, if you're 60 years old, you have to kind of weigh, the upside versus the downside, and maybe you just say right here, I'm stepping to the sidelines. If you're 20, you can afford to maybe make a decision down here somewhere below 2,500. So everybody has their own situation, and everybody needs to make their own decisions accordingly. Let's look at the 13-year, the 13-week Treasury, which is the very short-term Treasury, which is interesting. The Fed, the Fed is going to get behind here, and of course they're going to have to really catch up. But it was interesting is they didn't raise rates on their last meeting, and I suspect what's going to happen is this is going to start to take off. It's not going to wait for the Fed to raise rates. It's just going to take off, and maybe it chops a little bit like this, but then starts to take off, and then the Fed's going to be behind. So that's what it looks like to me is going to happen there. Of course, who knows? that's a little bit of a prediction. You know, we said back here that if it got above this red line, that the Fed would start raising rates, and they have. All along here, they've been raising rates. All right, let's look at the 10-year. We already looked at it, but let's look at it again real quick. You can see here the important low was here. First move off the low was here. This has all been retracement. Let's just we talked about the retracement back when this was happening. But let's just take a look at it again. So if we go from high to low, from low to high, so from right here to the high, which is right here, we can see that this retracement didn't quite make it to 50%, which is, you know, it's not unusual. 38% is usually the minimum. 50% is a better retracement. But this is looking very impulsive. So, in other words, this doesn't look like, this right here does not look like a larger retracement to the previous trend. It looks like, in other words, this, you can see how this is very overlapping. You got this one move down, then you have this ABC up, and then another move down. This is likely the ABC, and this is likely going to be the 1, 2, 3, 4, 5. So again, if you have bond funds, in other words, you're in bonds inside your 401k, inside your IRA, the next time you look at your portfolio, you're gonna see that you've lost a significant amount of money on those positions. And if you stay in those positions, you're going to lose a lot of money. People are just now starting to talk. I don't know why, people haven't been talking about this for years, but people are just now starting to talk about things like inflation and the government debt. We just had this tax cut, and people now are criticizing it because it increases the debt. And I mean, for decades now, nobody's even cared about the debt, and all of a sudden people are interested in it. But that's the way it is. Okay, that's the way it is. It's things like debt and excess debt. It's okay until it isn't. And even though you could see this coming from a decade away, what's happening now is things are changing in the market, and people are starting to reevaluate some of these things. And as this trend, develops itself, and more rapidly so, people are going to abandon these positions they've taken, and they're going to change positions, and this is going to really, really accelerate this interest rate higher. And so, just be very, very careful. Again, it's your money. You do what you want, but if you're an older person and you have bond funds, you need to seriously consider taking those to cash and keeping some of that powder dry. And yeah, you're not going to make any income, but if you leave, you're not going to make any income anyway if you leave it in those funds. So again, this is not a recommendation. You have to make your own decisions, but be very, very, very careful with these types of situations. All right, let's look at these countries. Germany, looks a lot like our market. It doesn't look like it's retraced quite as much. Japan looks just like our market and has retraced quite a bit. I mean, Japan could go up and close this gap. This is a pretty big gap here between this week and this week. So Japan could go up and close the gap, or it might not. The gap may just stay on the chart for a while. Same thing with the UK. We've got a pretty big gap here. So, maybe this goes, maybe, who knows, maybe this stops and goes higher. But to me, the risk to the downside is just too great on all these charts. And I don't know that I would be messing with it too much. All right, let's look at, let's go to the charts and look at gold. This is the weekly chart on gold. And I don't know, gold's been chopping around here a little bit. I mean, literally it could go up in here and then sell off, which I think from just the way the chart looks, I think it really needs to go up in here around 14, the mid 1400s. Maybe just maybe this 1450 to 1475 area. In fact, let's make this box a little smaller and put it back 14. That's about right there. So, you know, I just wouldn't be long or short gold here. I'd wait till it either got here or got here, and then I would take a position. But just the way this looks, let me show you a little trick here. If you go to Fibonacci extensions, which is this right here, and you grab this low down here somewhere, and you come up to this high, and then back down to this low. So this is, you know, if this is A and this is B, then C should be about as long as A, which would be right here at 1457. So I you know, if you put a gun to my head and said which way is this going to go, I mean, I would probably say higher. Gold's likely to go up to the 1450 to 1470 area before rolling over and coming down and eventually making a lower low, lower than this low back here, which is 1050, 1044. So we should see gold. If you look at the big picture, here's the run up in the bull market. We're gonna have some sort of retracement, right? So let's grab that tool again, and this time let's look at the Fibonacci retracement on the larger move. So from the high down to the low, and let's say that the high gets up here, let's say 1475. That means we could have gold down here at $600 before it's all over with. Let's say $775 to $600. So that would be a very proportional move, you know, A, B up to 1475, and then C down to, call it 750. If gold gets down to 750, 725, you should, you know, again, I can't make a recommendation, but you probably should just buy everything you can get your hands on, because the inflation that's coming after this correction down is huge. In fact, it's not even on this chart. We could speculate. Let's say we had a move. Let's do a Fibonacci inverse retracement. So let's go from high. Let's say it goes all the way back to. Let's just be conservative and say it goes back to 700. It's about right there. That puts the wave 3 in gold to around $5,200. Now that's a big move, and you can just imagine what that inflation is going to do to the dollar. So, you know, so the big picture here is hold dollars now, okay, in deflation. In deflation, the dollars you hold will be worth more in the future than they are today. They'll buy more, okay? Think of it like that. You can save your money and buy a house in the future for less than houses are today. You can save your money and buy gold in the future for less than gold is today. You can save your money and buy silver in the future for less than silver is today. But once this bottoms and starts going the other way, now your dollar is going to lose value. So that's when you need to be in assets, whether they be in oil, you know, oil companies, or gold and gold companies, or even stocks. The stock market is gonna really rally during that time frame. But we're easily. I mean, look at this. This went from what's the year here? 2011 or something? Was that what the high in? Yeah. So this is August 2011, and we're not talking about hitting a low in gold until, let's call it, I don't know, sometime in 2022, let's say, to maybe 2023. So if that's the case, then you know, we're not going to have inflation until, you know, let's call it 2022 at the earliest, and then, or 2000, let's call it mid 2021 at the earliest, and as late as mid 2023. That's just if the market takes the form. You know, the market form is very important in the market. So if we get a correction that looks like this, well, then you should see the low somewhere out here in, you know, 2023. Okay, if the form holds true. So hopefully I haven't confused you. That it's not my intent to confuse you, but I think it is important to try to get a longer term vision of where this is all going to go, so it gives you time to plan, because you're going to need some time to. Well, right now all you need to do is, you know, take your money, take it out of the market, let the market sell off, let assets sell off in general. Land is going to be cheaper. Houses are going to be cheaper. Cars are going to be cheaper. Everything will be cheaper. Your salary might even be less. Your employer may come to you and ask you to take a salary, or may lay you off. But salaries in general are going to go down because everything is going to go down. Dollars are going to become more valuable. In fact, the dollar, if you look at the dollar may have already turned. Do we have the dollar in here? It's DXY. So that may not be, maybe it's dollar DXY, dollar DXY. Yeah, dollar DXY. So, you know, the dollar's been going down for a little more than a year now. You had this big run up in the dollar, and then the dollar's been selling off for the last year. But this could just be a retracement in a larger dollar move. Let's see if we can get a bigger chart? No, that's it. I don't know what the dollar looks like back here, but to me this looks like a wave 1, an ABC, and then a 1, 2, 3, 4, 5. So this could be a wave A. So let's speculate. Let's speculate a little bit. So let me draw here. I tell you what, let's not use this tool to draw. Let's use the drawing tool on here. That way it'll be permanent. So hopefully you can see this looks like a wave 1. This looks like a wave 2. You can see the overlapping nature. And then you can kind of see a 1, 2, 3, 4, 5, okay? Which would be wave 3, right? Yeah, shoot. Sorry about that. This would be wave 3, and you can see that wave 3 is made up of 5 waves. It's interesting how this works, isn't it? Look at that. You can see 1, A, B, C, 2, 3, and a 4, 5, 4, 5. Or actually, this could be 4. This could be 3, and then A, B, C, 4, and then 5. So this pullback in the dollar is probably, if I'm guessing, it's going to be a wave 2, right? Well, it's likely going to be a wave 4. Okay, so this could be the end of wave 4, this move here, but likely it's probably an A wave that's going to look either like this, which it can't go that low. So that tells me, actually, I just made a mistake here. Because one of the rules with Elliott wave is this can't finish, wave 4 cannot finish in the area of wave 1. So you can kind of see wave 1 ends kind of in this area. So right now it's still okay, but the dollar needs to turn right here. So what does that mean? That means that that wave 4 in the dollar is likely to be some sort of sideways pattern, like so, down to here, and then finish with wave 5 up to here. Okay, so you're probably going to see some move like this in the dollar. which would be the end of this 1, 2, 3, 4, 5. Okay. But this is going to take a long time to develop. But the thing you need to know right now, the thing that's most important to understand right now, is that this move is over. It's got to be over, or this whole look is wrong. And to me, the look, if you look at the form fits. So it's more likely that this is correct. So the dollar has to stop going down right now, which it looks like it has. I mean, if you zoom in on this dollar, I mean, you could make a case that, you got kind of a double bottom here. You got a bottom with a rally and a retest of that, and then a rally. You got kind of an inside week here. So you can make a pretty good case that the dollar is off to the races. And is likely to head all the way back up here to around 100, or let's say 100 and 150, somewhere up in here. And then we'll look for some sort of sideways consolidation and then a breakout, and that would be the end of this move. So at the end of this move is probably, your low in gold, is my guess. Hopefully that makes sense. I don't know. Regardless of if the dollar's moving up this way, or if this is the rally, if this is the high in the dollar, the other possibility is this could be A, B, C, in which case this would be wave 1, and we'll know if this looks really corrective and stops in here somewhere. In other words, if it's very overlapping, then we could also at this time we could say, well, this is likely a wave 2. This is the first move down from the high. This would be the first correction, and then we would expect the dollar to pull all the way back down here to 70, 71 or so, and make 5 waves down. So, but there'll be plenty of time to look at that, and depending on how this looks right here, this rally up. In other words, if this ends up breaking down into something that looks like this, and then starts to roll over, then we know, then we think we know it's a possibility. Again, you would just be short the dollar here, but you'd have to account for the possibility that the dollar could go much lower at that point, which actually makes sense if you look at gold and you follow the story I was telling about gold. All right. Well, hopefully this hasn't confused you. If you look at the euro is going to move in the opposite direction of the dollar. So it looks like the euro is pretty much topped. I can't remember why I put this here, but it looks like it's holding, and it looks like the euro is going to start falling. So it's probably not too late. You could probably wait, let the euro quit falling, and then have a retracement, and then get short the euro. The U.S. dollar CAD, I'm kind of waiting for this to break out and then maybe retest this, but the truth is you could probably be long the U.S. dollar CAD right now and be pretty safe. And what you want to do is have a stop, just somewhere below the low, below the low of the bar you entered in. So if you were lucky enough to enter here, you have your low down here. If you enter here, then you have your low here, and as long as once it breaks out of here, it should pull back, but it shouldn't pull back below these lows. Okay, so if you wanted to go long the U.S. dollar CAD, to me you could probably do it right in here, and you'd probably be okay. All right, what else do we have? Oil, yes, oil. A lot of talking oil. Oil basically came up into our area here and gave up, started giving it up. So it looks like oil is headed back down. Probably soon this will become sharper, and then it'll be obvious to people that they're on the wrong side of the trade. And then I would look for oil to come down into this area where our box is, right in here. So the oil to kind of grind its way down into this area. It might fall sharply here in the middle and then kind of grind its way down into here. But here again, it should do kind of what gold's going to do, you know, pull way back. And then at some point as the dollar turns back down, then this should rally way up. So, in fact, in a year or two, this could be the trade, you know, probably be a great trade, you know, buy oil stocks and companies like that. So, all right, everybody. Well, I've been talking for about 30 minutes, so it's time to stop. But I just wanted to put this out because the risks right now are super, super high, and don't want to see any of you lose money. I don't want to see your family members lose money, and I think there's good reason to be very, very nervous of that. Okay? All right, everybody. Thanks for coming in this week, and we'll talk to you later. Bye-bye.